Okay folks, well, we've got another guideline update for conventional loans as it pertains to sellers for seller financing, and finally making it a little bit more simpler and a little bit less confusing for a seller. So thanks for coming into thecreditjungle.com today. This is George Anderson.
George of the jungle, strong as he can be.
And it's been pretty interesting because starting in 2018, Fannie Mae, and normally everybody follows suit. One of them will take the lead and then everybody kind of follows along. But they started changing the underwriting guidelines on how it would affect a seller to sell on seller finance. And there was a change in 2018 that we had to draft some different types of contracts so that it would satisfy the underwriter's requirements. Then there was another change in 2022. Then there was one in January of 2024, and there's been again another one in May of 2024. So to me, the underwriting guidelines are interesting because they are kind of a soft economic indicator of what's going on in the market. And the fact that we've seen 2022, 2024, 2 times already, 3 times in basically a 2-year period, is that Fannie Mae is seeing a lot more sellers that are selling their house on seller financing. So that's a good thing. So I want to explain what the changes were on this and how it affects a seller. There's some of the basic stuff that went in 2018 is still in place, but the last one has simplified a portion of it so that it basically goes back to the prior to 2018 guidelines. So let's just talk about, without getting into the sales price and everything else, we're just going to talk about what this is as far as a seller who has an underlying mortgage on his house is $3,000 a month, and he's selling that home and has a buyer that's going to pay him $4,000 a month, okay? And there's a broad band here that there might be different terminology for this, but we're just going to call, you can either have a lease option agreement, you can have a contract for deed, or you can have an all-inclusive trust deed subject to whatever that is an actual transfer of title. Contract for deed and lease option, the seller still retains the title in their name. The buyer has ownership and control of the property, but not title. It's kind of similar to a vehicle loan. So the current guidelines, if a buyer sells his home, okay, and selling your home, this is a form of selling your home, even a lease option agreement, you're selling the home with a rental agreement and the buyer has an option to buy. And that option money, regardless of how much it is, if it's $5,000 or $500,000, those funds are immediately an acceptable source of funds for the buyer to use as far as his funds of getting into the next home. So we can use that option agreement there, immediately can count the money, we can immediately count the down payment money here, we can immediately count the down payment money here. The difference in the treatment is, what does this contract, all 3 of these are going to create a $4,000 a month payment. Which one can we immediately offset the seller's mortgage payment so that they can qualify for their next home and not be burdened with having 2 mortgages, because this mortgage here is not going to get paid off. It's going to remain on their credit report. So the answer is, the only one that would allow you to do something immediately, to use the money and to offset the mortgage payment, is right here, lease option agreement. Well, what percentage of the payment here offsets that? Well, we only use 75% of that. So as you can see, 4,000 times 75% is $3,000 a month. You've got an offset on it. It basically offsets the underlying mortgage payment for the seller to get into another home. Now, this still has to run through automated underwriting, and the findings can give you some additional things. It can maybe want some reserves. They might want to see that he's got a prior rental history. But for most of your buyers who are selling here and then buying another home, if they're strong buyers, this is exactly how this is going to work. So what was the change? Well, up until May, when the guidelines changed on this, is that you couldn't count any of the income from either of these 2 contracts. Not a dime of it. Doesn't matter that the buyer came in with a large down payment and they've made their first payment of $4,000. you had to have a 12-month payment history before you could count any of it. And I don't want to get too much into the convoluted, I mean, this is really like mathematical gymnastics the way that it has been for the last little bit. But basically you would count this after you had a 12-month payment history, you would count this as income, but you would still count this as a debt. And that had a negative impact on the seller's debt-to-income ratios if they were getting into another property. Now, if the seller can qualify with 2 mortgage payments, just ignore all this. None of this matters, okay? Because your seller is a good, strong seller who's going to be buying a home. If you can qualify for a new mortgage payment of $5,000 and another mortgage payment of $8,000, okay, then they're fine. How we structure the contract matters not. For most people contemplating selling their home on seller finance contract, this is critical because the last thing you want to do is tell your buyer or your seller, if you're the listing agent for this guy, is that, hey, I have got a fantastic offer from a seller finance buyer who has a large down payment, and you're not only going to get full price for your home, you're going to get cash plus cash flow. Well, the seller says, hey, that sounds great. Let's go put another home under contract. And then they find out that because of the structure of the contract that they're not able to qualify. So what is the change? Okay, so the change on this most recent on here, and this is called debts paid by others, which is one section of the bulletin that came out, but you have to incorporate it with not REO Speedwagon, but real estate owned. Okay, so this is being a proposed rental because your buyer now is gonna, if he's selling on a contract for deed, he's technically going to be on title to 2 homes. If he's selling under one of these, he may not be on title, but he still has the mortgage. So there's 2 mortgages to consider, and he has other real estate owned. So between the interpretation of these guidelines, what we have now is a situation where we still can't count any of the income immediately. This is still the only one where we can count an immediate amount of income to offset by a percentage of 75% the seller's underlying mortgage. So this is though the mortgage is being covered, okay, and we're fine. What's changed on here is that once we have a 12-month history, so we need 12 months here, at the end of 12 months, once we can verify that the third party has been making the payment on each of these contracts and there are no delinquencies, that the payment's been being made on time, which is going to be evidenced by their credit report and by a third-party verification of mortgage that we're going to get to show that this other party, that they have been current making the payment to our seller. It's basically considered a sold property. We just exclude the debt. It's just as though the debt doesn't exist. Okay, so that's the change on there. And what the good thing about that is that what if the seller finance payment here is maybe only $500 a month more? It doesn't matter. So technically, as long as the payment that the buyer is making is equal to the payment here, then it still cancels out the debt because somebody else has been paying the debt. We have a 12-month history, no delinquencies, and everything's good. Now, the one thing that remains to be determined yet, and probably won't know about this until I see a transaction next year at this time, is that under the prior to 2018 guidelines, this seller would report this type of contract not on Schedule E, okay? This is reported on Schedule E of your tax returns, okay? These are recorded on Schedules B and D. So this is for rental income. This is for interest and capital gains. Prior to 2018, not only would we cancel out the mortgage payment, but we would also count at least the interest income, and if the buyer or if the seller here who's buying had a history of earning capital gains, we could count also whatever portion of their payment was a capital gain on there. That one we don't know about yet, but this is primarily going out to real estate agents who have taken the seller finance continuing education core law class that we teach right here in this office at First Liberty Title. But this is going to help you on how to structure the transaction for your seller so that it doesn't handicap them trying to purchase their next home. So thanks for coming into thecreditjungle.com. This is George Anderson. This is a supplement that we'll just kind of add on to a Zoom recording that we had with some other education. So hope to talk to you soon. Have your seller, before they accept those seller finance offers, have them call me, let's do a conference call, and let's crunch the numbers and make sure that we're structuring this for success. Have a great day, and we'll talk to you soon.
George of the jungle, strong as he can be.